Welcome to The Explainer. Today, we're going to break down one of the most talked about and honestly one of the most misunderstood tools in all of finance, options contracts. Whether this is your first time hearing about them or you're just looking to get a clearer picture, we're going to demystify this whole thing together. So first things first, why are we even talking about this? Well, it's because options aren't some niche thing anymore. They have absolutely exploded in popularity. And when I say exploded, I mean it. Just look at this number. Since the year 2000, the trading volume for options is up about 15 times over. And you know what's really driving this? It's not just the big Wall Street firms. A massive chunk of this is coming from regular, everyday investors. So with that kind of insane growth, it really begs the question, right? What in the world are these things that have suddenly taken the financial world by storm? Okay. To really wrap your head around options, you have to start with this one single, incredibly important idea. It's what makes them so unique. This right here is the absolute key to everything. An option is all about choice. You're buying the right to do something, but you are never, ever forced to do it. It's the power to make a decision, not a commitment to a transaction. And that choice is all laid out in the contract itself. Think of it like the official rule book for the deal. It spells out exactly what you can buy or sell, the price you can do it for, and, this is super important, how long you have to make up your mind. So let's break down that rulebook. The first key term is the strike price. This is the magic number. It's the price you and the seller agree on up front, and it's locked in solid, no matter where the market price actually goes. Now, of course, a deal this good isn't free. To get this right, you have to pay something for it, and that cost is called the premium. You can think of it as the entry fee you pay to have that incredible flexibility, that right but not obligation. And here is the catch. There's always a catch, right? Every single option has a ticking clock. If you don't use your right by the expiration date, poof, the contract disappears. It becomes totally worthless. This race against time is a massive factor in what an option is worth. Okay, so now that we have the basic ingredients, let's see how they get put together. This framework really splits into two main tools, each one designed for one of the only two directions the market can go. It really just comes down to this. Are you optimistic or pessimistic? If you're bullish and you think a price is going to shoot up, you buy a call option. That gives you the right to buy at that lower locked-in strike price. But if you're bearish and expect a crash, you buy a put option. That gives you the right to sell at a higher locked-in price. All right, now we get to the really exciting part. This is what attracts so many people to options, but it's also what makes them so incredibly risky. Let's talk about leverage. The best way to understand this is with a quick example. So let's just imagine there's a stock out there. We'll call it ABC, and it's trading at $100 a share. And you've got a really gut feeling it's about to go way up. So you've got a couple of choices here. Choice A, you could buy 100 shares of the stock directly. That's going to cost you a cool $10,000. Or there's choice B, you could buy one single call option which controls the same 100 shares, but look at that price difference. It only costs you $200. So let's say you were right and the stock jumps up to $120 a share. If you bought the stock, you just made $2,000, a 20% return. Hey, not bad at all. Now, what about that little $200 option? Well, after you subtract its cost, your profit is $1,800. Okay, yeah, that's a bit less profit, but think about your return on investment. You turned $200 into $1,800. That's a 900% gain. And this is where your mind really starts to bend. What if you didn't just spend the $200? What if you took the whole $10,000 you were originally going to spend on the stock and you put it all into options instead? Well, that 10 grand could have bought you 50 of those option contracts. And when the stock makes that same jump to $120, your profit after your initial cost would be a staggering $90,000. That right there is the insane power of leverage. But, and you knew there was a but coming, right? This is a huge one. With that kind of reward comes an equal amount of risk. That quote says it all. Options are a wasting financial instrument. Remember that ticking clock? That means that leverage can work against you just as fast, turning a small loss into a total wipeout. So with this wild potential for huge gains and devastating losses, who's actually using these things and what for? Well, it really all boils down to two very different goals, trying to stay safe or trying to get rich. On one hand, you have hedging. You can think of this as playing defense. It's like buying insurance for your portfolio. If you own a stock but you're worried it might fall, you can buy a put option to protect yourself from a big loss. But on the other hand, you have speculating. This is pure offense. It's making a big, leveraged bet on which way you think the market is going to move, just like in our example. We've seen the power, so we have to end by looking at the peril. Because trust me, understanding the risks with options isn't just a good idea, it is absolutely essential. You've got three big forces constantly working against you as an options buyer. First, the risk of a total loss. If you're wrong and that contract expires, your premium is gone, all of it. Second, time decay. That ticking clock is relentless. Every single day that passes, your option loses a tiny bit of its value just because time is running out. And finally, volatility. You might think a wild market is good for options, but it can actually make the premiums, the cost to play, so expensive that it's almost impossible to come out ahead. So at the end of the day, options are just tools. They're incredibly sophisticated tools that offer both tremendous power and significant peril. The real takeaway here isn't about whether they're good or bad. It's to ask yourself the question you see on the screen. How would this unique, high-stakes combination of risk and reward fit or not fit into your own personal financial plan?